1031, it's great because you can defer or reduce or eliminate much of the capital gains, but you
Yeah.
have to you always have to level up, right? You always have to get more debt. You have to get a bigger property. You have to abide by their timings, right?
Yeah.
90 days for this and 45 days for that. So what I did when I sold all of my active investments and what I continue to do is what we call the lazy 1031, which is basically you're not really doing a 1031 exchange at all, but every time you buy a new asset, you get a chunk of depreciation and paper loss.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Welcome back, Decoding Cashflow listeners. I'm your host, Ted Patel, and joining us today is Jim Pfeifer, who is a full-time passive investor, the founder and former president of Left Field Investors, and co-host of PassivePockets podcast. With a passion of empowering investors through education and community network, Jim has built a reputation for making alternative investment more accessible. He holds a degree in finance and marketing from University of Oregon and a master's in business education from Ohio State University. So with that said, Jim, welcome to Decoding Cashflow. It's a pleasure having you on the show.
Thanks, Ted. Nice to meet you, and I'm happy to be here.
All right, awesome. So, Jim, before we get into the things that you do right now, can you give our listeners a little bit background about what did you do before you got started in the real estate or the alternative investments, and how did you
Sure.
jump into this particular
Yeah,
niche?
I've kind of worked in a bunch of different careers. I started off right out of college. I was, really into finance and couldn't wait to get a paycheck so I could start investing in stocks and mutual funds. And my first job was I was an underwriter at a reinsurance company, and I did that for about 11 years. And then I transitioned. I became a teacher, and I was a high school teacher teaching finance and accounting, but it was really more life skills because it was a Columbus City schools where the kids weren't, they didn't have the resources needed for, so it was just basically life skills. Then
Mhm.
then I became a financial advisor, and the interesting thing about that is when you become a financial advisor, they start teaching you about money like you've never known money before. And at the same time, we became accidental landlords, so I was getting into real estate a little bit, and all the stuff the financial
Mhm.
advisor trainers were teaching me about money. I was looking at it and thought, this doesn't really apply to paper assets as well as it does to real estate. And so slowly I started getting into a little bit more real estate, buying some single family homes, some small multi-family homes. And eventually I realized that I was putting all my time and energy into real estate. And I always prided myself on, selling my clients the same investments that I bought. And I wasn't interested in paper assets anymore. I wanted real cash flow from real assets in real estate. So I transitioned to become a full-time, what I thought was a passive real estate investor by owning these properties, but it was certainly active now looking back. And made pretty good money on all of those properties, but not for anything that I did. It was just a really, really good time to be in real estate. The market went up in every different asset class that I invested in,
Yeah.
and so I made good money. But I realized I wasn't very good at being an active once I finally figured out it was active and not passive. And then I found this thing called syndications. And once I found real estate syndications, I started out, I wasn't really good at that either, but I learned and figured out how to do it. And I realized that's what I want to be. So now I'm a full-time real estate syndication investor. And along the way,
Mhm.
I was looking for education. It's tough to find education in real estate syndications. And so I started a little group. It was going to be a dinner club in my hometown of Columbus, Ohio, where we'd meet once a month just to talk about investing in syndications. And that was in March of 2020. And so our first meeting never happened because everything closed down because of the pandemic. Never happened in person. Instead, we went online and we did. They had this new thing called Zoom, and so we got on Zoom and started having meetings there, and realized that there were so many people interested in this, and also we had some pretty high profile people who would come talk to a 20-person Zoom meeting because no one had anything else to do. And so our group grew, and I thought of it as a mastermind for the first year, and we restricted the membership pretty severely. So we only had 50 people. And that's when we realized there was so much interest in this and so many people needing to be educated that we started a company. We got a website. We started Left Field Investors. And the purpose of Left Field Investors was to help people become better syndication investors, to connect them
Hmm.
with other people, limited partner investors, and also operators. And so that grew over 4 or 5 years, and then in the fall of 2024, we merged with Bigger Pockets to form Passive Pockets. And Passive Pockets has the same exact mission as Left Field Investors did, which is to help limited partner investors find investments, help them learn how to vet an operator, how to analyze a deal, all of that, while also connecting them with operators and other limited partners. So that's my long story.
Yeah, that's awesome. Yeah, that's quite a journey actually. So, yeah, so moving on from financial education, to full-time now passive investing, right?
Yes.
So, was there any like pivotal moment that made you think, okay, now, let's sort of get full-time into real estate? Any such thing that inspired you to do that?
Yeah, it was just really when I was working as a financial advisor and I was looking at the products we were selling, and some of them I still believe in, but others, I don't. Paper assets like the stock market, right? If you're investing in Apple stock, for example, Apple could have a great year. It could have the best year they've ever had. But if the economy and the stock market, if the overall stock market tanks, Apple's going with it.
Hmm.
And that just isn't the case for real estate. Yes, there's a market cycle, and when bad things happen, it usually happens to most properties, but it's much more local. And with real estate, if I'm owning the real estate myself or I'm investing in a syndication, either way, um, maybe I don't have control in syndications, but I can call up the operator and say and ask questions. I can go visit the
Yeah.
property. But if I have questions about how Apple's doing their business, I can't call Tim Cook and have a discussion with them. So, there's a lot more, even in passive syndication, there's a lot more control of the investment. But also you get great tax benefits, which you don't get with
Yeah.
paper assets. You get
Hedge
cash
against
flow.
inflation, right?
Yeah, and you
One
get
of,
cash flow. So really what I found out was that if you're investing in paper assets, the stock market and all those other things, that's speculation, right? Because what you're doing is you're investing, you're putting money in, and you're hoping that at some point in the future, someone else will buy that piece of paper from you for more money than you paid. Now you may get small dividends along the way, but not always, and sometimes not at all. But you're basically hoping someone else will buy it for more. Where in real estate, you're buying a real asset, right? That hopefully, if you're buying the right assets, it's cash flowing. So you're receiving a benefit currently while you're holding the asset. And then the appreciation on the back end is just the bonus. You don't really need that. Where in paper assets, all you're going for is the gain at the
yeah,
end, right? And so speculation isn't necessarily bad, but if you think you're investing in the stock market, you're not. You're speculating. With
yeah.
real estate, you're investing, and you have to know which one you're doing. And I allocate most of my capital to investing, not to speculating.
Yeah. And you rightly said, right? In the stock market, you have a very limited control. You don't have the control on on the company's performance, right? It's just there are other than that, there are so many different moving parts, as you mentioned earlier, economics, or market, international risk, many many different things plays a role into the stock prices. And on in the real estate, it's more of you have a control, on how to add value to the property, you know,
Right.
how much dep and other benefits that you can get is like depreciation, inflation against hedge against inflation, many other benefits. It's not like, there's no harm in investing in stock market, I would say, right? People have been doing it for years. Some of them have been reaping good benefits, but it's always
Yeah.
a good advice, according to me, I would say, to diversify your portfolio. Don't
Yeah,
put everything in the same basket. Don't put everything in the stock market. Just diversify,
absolutely.
go get into real estate, hedge yourself.
Right. And if you look around, right? Look at your friends, your neighbors, or even famous wealthy people you know.
Yeah,
I would bet that none of them gained their wealth investing in the stock market, right? They either owned businesses or invested in businesses or owned real estate, right? You don't
yeah,
get rich investing in the stock market. It just doesn't happen. It's very few and
yeah,
far between. But if you look at people that invest in real estate, that's how they build wealth all the time. And a lot of that is because, the tax code is built in favor of real estate investors. If you do it right, you're not paying taxes, and taxes is the biggest eroder of wealth. So
yeah.
imagine if you can eliminate or reduce legally the amount of tax you pay, that's much better than getting an extra 5% return or 10% return on any investment you're doing, because
Yeah.
taxes are such a big eroder of your wealth.
Absolutely right. And in the real estate, you have these options of 1031 exchange, as you mentioned, right? And always leverage those options, defer the taxes, uh, and the methods of, just refinancing it, pulling out the money from the real estate. There's no tax on the loan amount that you pull out, right? So
Right.
you can
And
always
I
keep doing that as long as you hold the property.
I would also say, 1031 is like, I don't like to partner with the government or be, have regulations and restrictions, right? And in 1031, it's great because you can defer or reduce or eliminate much of the capital gains, but you
Yeah,
have to, you always have to level up, right? You always have to get more debt. You have to get a bigger property. You have to abide by their timings, right?
yeah,
90 days for this and 45 days for that. So what I did when I sold all of my active investments, and what I continue to do, is what we call the lazy 1031, which is basically you're not really doing a 1031 exchange at all, but every time you buy a new asset, you get a chunk of depreciation and paper loss, right? It's not as much
mhm,
anymore with 100% bonus depreciation gone, but you
yeah,
still get that loss. And that loss offsets the gain from the asset you just sold. And so if you continue every time you sell an asset, you buy an asset, then effectively you can defer and eliminate and reduce your taxes without having to do this heavy burden of the 1031 exchange. And it's for syndication investors, it's a great strategy.
yeah, absolutely. Love it. So now, Jim, what are the different suggestions that you'll give, right? For example, anyone who is interested in getting into the real estate market, investing passively, uh, what is the biggest mindset shift according to you that they need to make?
Well, first of all, you have to understand what passive is and what it isn't,
Yeah,
right? If you're buying a single family turnkey rental, that's not passive. You are the asset manager. You are
yeah,
going to have to manage the property manager, right? So anything where you are actually owning the property is likely not very passive. And you have to figure out what is passive to you, right? So that's kind of step one. But if you're going truly passive investing, and by that I mean into syndications, that's what
yeah,
most of what I do. You have to be willing to give up control, right? We talked about control. You do have some control, but once you wire that money to the operator, you have very little control. And so you have to be comfortable with that. And the only way to get comfortable with that is to find operators, partners who like, and trust, right? That you
yeah,
understand they're looking out for your best interest, because you are a business, you're a limited partner, you're a business partner. You own part of the limited liability company that's buying this asset. So
yeah,
control is one thing that you're going to give up. It's also, these are extremely long-term illiquid assets, right? Because if you buy a single family turnkey property and you need money, you can sell it tomorrow. You might not get the amount that you want for it, but you can sell it. So it's a
yeah,
lot more liquid than a syndication investment, which you're stuck in. You can't get out of. And so the mindset you have to get in is, I'm going to do all my vetting up front. I'm going to find partners who I trust, who I verify their track record, and I know they're going to do a good job. And then I have to understand I'm also giving up liquidity. And that's something that people really don't realize. For instance, if you're investing in 2019, 2020, 2021, all those deals were the pro forma. They were projected to go for 5 years and then
Yeah.
sell, right? But most of those deals were going 2 or 3 years because the market was so hot. People were just flipping these properties. And so your expectation as an investor is, oh, everything says 5 years, but it's 2 or 3. So when you're investing, you're not thinking about I might not get my money back for 5 or 7 years. You're thinking 2 or 3. So then in 22, 23, the market changes severely. And now they might pro forma at 5 years, but it's probably going to be 7 to 10. So
Yeah.
now, even though some of those investments you did in 2021 that you thought would be 3 years and you get your money back, or worst case 5, it might be 7 or 10 now. So you really have to think about liquidity and where you are in the market. And those are some of the mindset shifts you need from going from active to passive.
Yeah. And as I said, right, it's all about your risk appetite. You need to evaluate how much risk you can take, how much period you can tie up the money in certain investments. Do you need the money now? Do you need it in 3 years, 5 years, or it's okay if it stays a little bit longer, right? And always, as you know, like none of all the deals, yes, you vet the good operator. They might have gone through numerous good cycles, or they might have provided a great return on investments, but you also have to consider, that's the past performance, not the future. There are certain risks to all the investments.
Yeah, absolutely. It's an investment. It's going to have risk for sure.
Yeah.
And the biggest risk is the operator, that the operator knows what they're doing. And when you're looking at track record now, um, anyone who invested in the 20 teens is going to have a great track record. I did, and I was a terrible asset manager, right? I made money in all my investments, but not because of anything I did. And so I think now, as you're investing in new deals, track record takes on a whole new meaning, because if someone's been in business for more than 2 years, then they've been through the difficult times.
Yeah.
So, as an example, in 2019, and if one of the questions we always ask an operator is, hey, have you ever had a capital call? And if they had said yes in 2019, that would have been huge red flags. Everyone said, don't ever invest with that operator. Oh my gosh, a capital call. And now a capital call is totally different, right? Because many, many operators have gone through that. And so it's a different evaluation. It isn't necessarily, oh, you had a capital call. Absolutely not. It's, oh, you had a capital call. Tell me more about it. How did
Yeah.
it go? How did you communicate it? All of that. And that's the important part. So now I think it's actually going to be easier to evaluate operators because they've had some rough times. And
Mhm.
it's easy to evaluate somebody when their track record is all 30% plus IRRs, right? But when it varies and when you lost some money, then, now I can really dig in and ask you some questions.
Yeah. And how did you mitigate those risks, right? How did you uh, came out of that hole? If you
Absolutely.
went, yeah. All right. So, Jim, being a passive investors, what are the main assets you focus on? Is just the multifamily or many other assets?
No, I try diversification is the most, well, maybe second most important thing after quality operators, right? Is diversification.
Yeah.
So I invest in multiple asset classes. Of course, most people enter with multifamily because that's familiar. Everyone's lived somewhere, right? And most of us have lived in an apartment at some point. So that's the most familiar. But there's still self storage, there's industrial, there's triple net leases, commercial. Now there's car washes, RV
Hmm.
parks. There's just so many different asset classes. And, my goal is to diversify in as many different ways as possible. So I diversify by market. So I'm in a lot of different markets, operators, different operators, asset class, different debt structures, as many different ways as I can diversify. That's one of the big benefits of being a passive investor in syndications. Because if you are, again, just to go back to most active real estate investors are doing what single family homes or small multifamilies. So you're only in one asset class. So you can't diversify very well. You might diversify by market, but if something hits the, U.S. housing, it's going to hit you. So diversification is key, but I'm in as many different asset classes as I can find quality operators.
hmm And talking about the operators, right? What are the strategies or uh, things that you do to evaluate the operator? Just to make sure, not only for you, but anyone, uh, if there are other investors along with you investing in the deal, you
Mhm.
keep in mind their benefits also.
Yeah, so with the operators, I've kind of gone on a journey there where the first way I did when I first got into syndication investing, I went to a conference, and I was totally naive, and I thought, okay, if an operator's at this conference, it's put on by someone very trusted and well known in the industry, and so I thought, well, if an operator is here, they must have been vetted, they must be top of class, and they must be awesome. It's not true. What is true is they're there because they paid to be there, which I figured out. But so what I did was I just walked around the conference. I had an old 401k that I rolled over into a self-directed IRA, and I kind of walked through the conference saying, "Oh, hey, here's some money, here's some money, here's some money," to different operators without vetting them because I just thought if they're there, they're good. That was a disaster. Some of those investments worked out, some didn't, but it was a terrible, terrible way to vet operators. Now, conferences are a great place to go and meet operators, but just
hmm
because they're there, don't invest with them, right? That's just step one.
Sure.
Then I figured, okay, that's not the best way to do it. So I started listening to podcasts, and as people say, I went to podcast university, right? So then I started. Anytime I'd listen to someone, an operator on a podcast, I'd call them up and have a conversation. So now I'd listen to them for 30 minutes on a podcast, and I'd had a 30-minute to an hour conversation with them on the phone, and that was much better. But still, they're going to ask me to wire them $50,000. And I've heard them on a podcast and talked to them for 30 minutes. Right. So I still don't know if they're a great operator. Are they a great marketer, podcaster, or all of the above? I don't know. And even if they would say, hey, here's some, you can call up some of my clients, they're just going to give me their best clients. Right. So
Yeah.
everybody I call is going to be like, yay, they're great. So that was much better, but it still wasn't where it needed to be. And so then once we had the community of left field investors, now Passive Pockets, that's where I really honed my skill at evaluating operators. And now I will not invest with a new operator unless they are recommended to me by someone I know, like, and trust who's in my community who's already invested with that operator. Now, they
Mhm.
don't have to have gone full cycle on a deal with them, but at least they've invested with them. So they know they can confirm to me, hey, you sent your wire. Did it get there? Okay, that's check number one. Did they send out distributions like they promised? And if not, did they explain it? Did they send out quarterly or monthly reports like they promised? And can I see examples of it? So then I still do all of the same evaluation and call them up and have a conversation and ask them all kinds of questions. But now I'm starting 100 steps ahead, right? I'm starting from a place of trust because trust transfers, right?
Mhm.
If you've invested with somebody and we know each other and I trust you and you trust that other person, then hopefully I can
Yeah.
trust that other person too. And so that's a long way of saying now that's how I start my evaluation with operators. Now there's other questions I ask. I ask about track record. I want to see their communications and all of that. But I start using my community. And I think, and we can talk about this more if you like, I think the number one way to become a more effective and better investor in syndications is by joining a community because this is a different kind of investing. And to have other people to share information with and learn from is absolutely critical.
Yeah. Yeah. Always be with the like-minded people, right? That's what the saying goes. So better
Absolutely.
join the community of people who has already achieved or in the process of achieving what you plan to do.
Absolutely. For
Yeah.
sure.
All right. So, with regards to left field investors, can you tell us some more about the company? Like, how do you structure the deals? Like, is it a fund of fund models, 501(c)(C)? Of course, it is syndication, so it is a C. But can you tell us more about how you manage these funds from the investors?
Well, we don't manage any funds, and it's not left field investors anymore. We merged with bigger pockets to become passive pockets. So the
Uh-huh.
community is passive pockets, and we don't manage any deals at
Okay.
all. We are
All
just a
right.
community of limited partner investors. And one things that we do is we have a forum so that LP investors can get together and discuss operators, deals, strategies,
Hmm.
all of that. So it's a community where you can go talk to other investors. We also have a forum where you can talk to operators, and they're
Yeah.
separate, so you can have private conversations about the operators. Then you can also have public conversations with the operators. We also, there's all kinds of tools. We have a deal analyzer that kind of helps you figure out, hey, it doesn't tell you if this is a good or a bad deal, but it gives you,
Hmm.
helps you figure out questions to ask of the operator. And we have other resources like that. We have we post deals, and we have operators that are on the platform, but they post their deals. Um, and then we do deal reviews. So again,
Hmm.
we're not recommending anything, but we'll have an operator on and they'll pitch their deal. And then we have a panel of three experienced limited partner investors, and we ask them questions. And we ask them
Okay.
tough questions because our goal is to show our community, hey, if you're just starting out, here's some things you can ask. And some people are afraid to ask the tough questions, but that's absolutely what operators want and need to be asked. And so we'll do that for about 15 minutes. Then at the end of the webinar, each LP, experienced LP, will say, if I had capital to allocate, would I consider this deal? Yes or no. So again, we're not recommending. We're just saying, hey, this deal I might consider, this one I might not, and then we state all of our reasons. So it's an educational platform,
Hmm.
but we also connect you with operators so that you can review deals as well.
Yeah. So it's more kind of a, as mentioned earlier, community network, right? All like-minded people come together, vet the
Absolutely.
operators, and they invest individually based on their preference on the
Yeah, and
community.
then
Yeah.
there's a lot of sharing, right? People say, "Hey,
Yeah.
are you going to invest in this deal?" I am, I'm not, that kind of thing. And it's an
Yeah.
online community, but we also meet in person. We have a meetup coming up in Columbus, Ohio in May, and that's where, the meetups we've had in the past have been super successful because we do a lot of networking. So as an LP, you're meeting all these other LPs and comparing strategies and operators you've invested with and everything you've done. And then we also have operators and general partners there, and you can meet them, and we make sure that you get to network and see them. So there's just a lot that we do in the community, but is all in support of limited partners. Because let's face it, especially now, we've gone through a really tough stretch, and there's operators that have lost LP capital, and there's
Hmm.
operators that have lost LP capital and haven't had good reasons or haven't communicated well or haven't been fair in their communications and evaluations. And so a lot of what we're trying to do now is point out, hey, here's some operators that are doing things the right way. And then we also are trying to shine a light on the operators that are not doing things the right way.
Yeah. That's good. That's great. And how does this collaboration with bigger pockets help the pockets community grow? Like, do you see any significant jump in the community or
Yeah,
any? Yeah.
absolutely. I mean, at Left Field Investors, I feel like we had a great community. It was a smaller community, and it was hard to sustain because we didn't have resources, right? And
Hmm.
the resources we had were not sufficient to do all the things for the community members that we wanted to do. And so we reached out to Bigger Pockets. They were thinking about starting their own community, and we realized that what we had was the expertise. We'd done this for 4 years, and we
Hmm.
knew what LPs were looking for. Bigger Pockets has the resources, but they didn't have the knowledge of, syndicators and how that world worked. And so it was a perfect partnership. And so what we get from Bigger Pockets are resources, and also they have a community of 3 million people, right?
Yeah.
So they know how to run a community. And what we have is, it's very niche. It's syndication investors. That is our target. And so Bigger Pockets helps us, develop a better community and gives us a lot of resources to help grow that. And the resources are, a lot of knowledge and expertise as well.
Hmm. Okay. So it's just like a collaboration, right? It's nothing like sharing profits, or there's no money exchange taking place, if I recall it right.
Well, Bigger Pockets owns Passive Pockets.
Okay.
Um, yeah, so I mean, they bought Left Field Investors, and we essentially changed the name to Passive Pockets. So they
Okay.
own us, but Passive Pockets does stand alone. Bigger Pockets, again, they help us with resources and things like that. But Passive Pockets is a standalone entity that is owned by Bigger Pockets.
Mhm. Okay. Got it. Okay, but anyways, it's a great place to be, right? When you have a good experienced investors as well as operators under the same umbrella, the knowledge that you can gain out of the community would be unmatched.
Yeah, it
Uh,
really is. And like I said, I don't think I'm obviously biased. I think Passive Pockets is the best community out there. But I tell limited partner investors, find a community. If
yeah,
Passive Pockets doesn't fit, go find one that does, because there's others out there and they're
yeah,
great too. So you got to find a community where the culture of that community fits your personality. Because as we've talked about, it's really hard to be a syndication investor. You should not do it unless you have some knowledge and are willing to educate yourself, right? It's not just like
that's
going
true.
out and buying a property that you manage. It's very different. And so having a community of like-minded individuals, and we have everything from people who haven't invested in a deal yet to people who've invested in over 100 syndication deals and everything in between. So it's a great place for someone just learning to kind of dip their toe in and ask some questions. And our forum has thousands of posts that you can read. So there's just nothing better than a community for this type of investing. And I've done all kinds of different investing. You don't need to be in a community to go buy Apple stock, right?
Yeah,
Or to invest in the stock market. And you're going to get that shoved down your throat by your financial advisor anyway. So what you need here, and if you ask your financial advisor for help with a syndication, they're going to say that's too risky because they don't understand it. They don't know
mhm,
it. They're not licensed for it, so they can't sell it to you. And every time you invest in a syndication, you're taking money away from them. So they're not gonna feel comfortable or not want you to take your money away. So really the only place to learn about it is a community, or if you find that unicorn financial advisor who understands real estate and is willing to incorporate in their financial modeling, they're still not going to be able to recommend deals to you because they're not
yeah,
licensed for it.
that's true. That's very true. All right. So, hey, Jim, loving this conversation, but also want to be mindful of your time. Would like to move to the final round of questions. But before we go there, is there anything else that you'd like to tell to our listeners before we move on to the final round?
No, I think we covered it. Like I said, you're going to hear me saying community, community, community all the time because I just believe so strongly in that, and that's really what's helped me become the investor I am, where I can be a full-time passive investor, and it's because of the community that we've built.
Yeah. All right. So, ready for the final round of questions?
Let's do it.
All right. So, which is the one book that had a major impact on your life or on your business?
The book that I have read recently that has really helped me is was written by one of the founders of Left Field Investors, Steve Sue, and it's called "Avoiding Rookie Passive Investing Mistakes." And what it is basically his 15 years of experience put into 20 mistakes that he's made or seen others make in passive investing. And I read that every couple of months, read it again, because all it is this is learning, right? How do you become a great investor? By learning from other people's mistakes and successes. And
Yeah.
so if you can look at this one book and knock off 20 mistakes that you're not going to make, and I've made most of them as well. Steve just put them in a book. It's just a kind of it's just a great book, and it's an easy read. It's a short one, but that's my number one book for sure.
Mhm. What are your main source of information to learn and grow?
Well, I think you're going to guess the answer to this, and that's my community, right? If there's something that comes up and we don't and I'm not sure about it, I just go to my community and either ask the question or it's already been answered. And I think that's because it's so hard to find quality information these days. You search syndications on the internet, I have no idea what you're going to get. But the strategies of investing strategies and all of that I am doing today, a lot of it comes from the people in my community. So absolutely the community is the number one place.
Awesome. And what is the one habit or routine that has been crucial to your success?
I think for me, just getting out every morning, the first thing I do is I go for a long walk. I listen to podcasts. I listen to entertainment podcasts, and then I listen to business podcasts, and then I finish up with real estate podcasts. And just getting out in the morning and spending an hour or more walking and just relaxing and listen to podcasts is just a great way to start the day.
Sounds great, man. That's awesome. So, final question. How can Decoding Cash Flow listeners get in touch with you?
The easiest way is to go to PassivePockets.com. If you're interested in joining, there's a 7-day free trial, so you can try that out. And if it's not for you, you just leave before the seven days end. But you can connect with me there. We have a direct messaging capability. You can also email me, jimpfeifer@biggerpockets.com. I talk to investors all the time, and I'm more than happy to do that. But the best place is, and also LinkedIn. But I would say if you go on the PassivePockets.com website, that's the best place to connect.
All right. That's good to know, man. Jim, thanks a lot for being on the show. It was a pleasure.
Thank you, Ted. Thanks for having me.
All right. Thanks a lot. Bye.
Thanks for listening to Decoding Cash Flow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cash Flow, and we'll catch you in the next episode.